In this video, we're going to be covering the second part of Chapter 7, and it mainly focuses on cash. And cash is an easy account that we can all relate to because we all understand cash, we deal with cash. It's just we need to understand more about how cash works in a business. So cash includes any kind of coins, currency like paper money, checks, and even money orders that the business is holding. So money on deposit with a bank or other financial institution that is available for withdrawal is also considered cash. So something like a checking account, that would be considered to be cash. So cash is the asset most likely to be stolen or used improperly in any kind of business. And why is that? Because it's hard to find a way to document that this cash is mine, unless it's like secured in a bank or something like this. So imagine if I have a $20 in my pocket and one way or another it jumped to someone else's pocket, then it's hard for me to convince anybody that this $20 belongs to me. It's not for that person. So there's nothing on the cash itself, especially like paper money, that can prove that this cash belonged to someone versus the other. So how we can control cash receipts. And we'll talk about cash receipts and cash payments, and we'll see the difference. So let's see the control of cash receipts for any business. So to protect cash from theft and misuse, a business must control cash from the time it is received until it's deposited in a bank. And that's the critical time. And that's usually why we see many businesses, they deposit cash on a daily basis. So they go to the bank, or there's an employee who will go to the bank on a daily basis to deposit any kind of cash. So businesses normally receive cash from two main sources. One source would be the customers purchasing products or service using cash. And I think over time we're seeing this going down day after day. However, there are still people who like to use cash to make any kind of purchase. In some businesses, they don't even allow the use of cash payments for purchases. For example, I was trying to rent a car from I think it was Enterprise, and they said we don't take cash. You have to use a credit card or a debit card. And the other reason that businesses receive cash is whenever their customers are making payment for previous account balances. So customers making payments on account, this is where we also receive cash. So we have a previous sale that was on account, and now the customer is paying the cash. So this is another reason that we're getting the cash. So now let's talk about cash received from cash sales, which is the first category. So an important control to protect cash received in over-the-counter sales is a cash register. And we've all seen that, where they have this kind of unit that just records any kind of sales transaction. So here we have like a diagram that hopefully we can all relate to. So we have a customer, let's say in a grocery store. They're getting the merchandise, and of course they get the receipt from the cash register, and at the same time they provide the cash for the cash register. And here we're assuming that this customer is paying in cash, not paying using credit card or debit card. So the cash is going to be collected by the cash register, and the cash register would create two copies of receipt. One copy would go to the customer, and one would stay with the register. At the end of the day, the cash register would provide all the cash to the cashier's department, where they make a cash deposit, usually the next day, to the bank. At the same time, all receipts that are issued by the cash register would be sent to the accounting department. The accounting department would match these receipts received from the cash register by the deposit ticket that was issued by the bank when there was a cash deposit made by the cashier's department. And they make sure that they match, so the amount of deposit in the bank is equal to the amount of receipts that were issued by the cash register. Once they match, they record it in the books as a journal entry. So salesperson may make errors in making changes for customers or in ringing up cash sales. As a result, the amount of cash on hand may differ from the amount of cash sales. And such difference are recorded in an account called cash short and over account. In many cases it's cash short. In very few cases, sometimes there's a cash over when a customer overpays for their purchases. So let's see this example. The cash register total for cash sales for May 3rd totaled $35,690. However, cash receipts from cash sales totaled $35,668. So you can see that there are $22 difference. Of course, it's a large amount, like you see here, $35,000, like we're close to $36,000. And having a difference of $22, this is something that could always happen in retail businesses especially. So the cash sales, receipts, and shortage would be recorded as follows. So in this case, we can tell, if you look at the numbers, you can see that whether it's a cash shortage or a cash over. So you can see that the cash sales were $35,690. However, the cash receipts were only $35,668. So it's below the cash sales. So this tells us that this is a cash shortage. We have a shortage in the amount of cash that we have. So how are we going to record that? So we're going to credit sales, because remember, sales are revenues. They are going to be recorded on the credit side. We're going to debit cash, and this is the amount of cash that we received. And if they're the same, then this is fine, because these are equal. The problem is we have $22 difference. So we record the sales based on the actual sales value. And we record the cash based on the amount of cash that we collected. And the difference, the 22, is going to be the cash short and over. So 22 is the cash short and over, and it's on the debit side. And this indicates that it's a shortage. If it wasn't over, you can find that the cash short and over would be on the credit side. So if there's a cash shortage, as I just said, the cash shortage and over account is debited for the shortage. If there's a cash overage, the cash shortage and over account is credited for the overage. So I think that's easy. And you can think about it like if the shortage is on, if the account is recorded on the debit side, then this is like an expense. And if it's on the credit side, so it's like a revenue. So if we have an overage, it's on the credit side. If we have a shortage, it's on the debit side. At the end of the accounting period, a debit balance in cash short and over is included in miscellaneous expenses on the income statement. So we don't really record it separately. We just record it as a miscellaneous expense. And we always hope that this is not a big amount. Alternatively, a credit balance is included in the other income section of the income statement. So now let's talk about cash received in the mail. And that's another important thing that we have to consider whenever we are thinking about controls. So cash is received in the mail when customers pay their bills. This cash is usually in the form of checks and money orders. Most companies design their invoices so that customers return a portion of the invoice, we call it the remittance advice or the remittance advice, with their payments. This document helps to control cash received in the mail. So usually you get the check or the money order with this remittance advice, and that way you can match this check is paid for what customer, for what payment, and so on. How about cash received by EFTs? And EFT is short for electronic fund transfers, and this is getting to be more popular nowadays. So we see many customers, they make their payments using EFTs. So cash may also be received from customers through that form. So for example, customers may authorize automatic electronic transfers from their checking accounts to pay monthly bills for such items as cell phones, internet, and electric services. So this is something very common nowadays, and businesses, they love it because customers would never forget to make these kind of payments, especially if it's like automatic pay. In such cases, the company sends the customer bank a signed form from the customer authorizing the monthly electronic transfers. Each month, the company notifies the customer bank of the amount of the transfer and the date the transfer should take place. On the due date, the company records the electronic transfer as a receipt of cash to its bank account and posts the amount to the customer's account. So companies encourage customers to use EFTs for many different reasons. Let's see some of these reasons. One of those reasons is that EFTs cost less than receiving cash payments through the mail. And people would think, why is this? Is because you have to have an employee who would go on a daily basis and deposit the cash into the bank, or maybe take the check and deposit in the bank. In EFTs, you're saving this time for that employee. You don't need that employee. So it actually saves some money. Also, EFTs enhance internal controls over cash, since the cash is received directly by the bank without any employee handling cash. So it's a controlled procedure because now we're getting the bank involved directly. And again, it's having like some kind of a separate record on the bank side that they keep track of our cash collections. And another reason is EFTs reduce late payments from customers and speed up the processing of cash receipts. So no lost mail, no delays in payments. It's automatic pay and it gets deposited in our bank directly. So this is usually very, very good. Now let's talk about controls for cash payments. And here we're going to be talking about the control of cash payments that should provide reasonable assurance that payments are made for only authorized transactions and cash is used effectively and efficiently. For example, controls should ensure that all available purchase discounts are taken. So the controls basically for cash payments is making sure that we are using the cash for the intended purpose. And the other thing is that we are taking advantage of any kind of discount that's available for us. So when we're talking about cash payments, there's something called the voucher system. And a voucher system, it's a system created within any business to keep track of the purpose of this payment and make sure that it's recorded properly based on what we should pay. So a voucher system is a set of procedures for authorizing and recording liabilities and cash payments. It may be either manual or computerized. Of course, nowadays, even on small businesses level, computerized systems are getting to be very common. So something like Peachtrees, for example, that's an accounting software, or QuickBooks, another accounting software. Usually they apply these kind of voucher systems. So a voucher is any document that serves as proof of authority to pay cash or issue electronic fund transfers. In a manual system, a voucher is normally prepared after all necessary supporting documents have been received. So once we have the invoice, we have the approval, the authorization, then the next thing would be to issue the voucher. So for the purchase of goods, a voucher is supported by the supplier's invoice, a purchase order, a receiving report that we got the items or the goods that we ordered. So after a voucher is prepared, it's submitted for approval. Once approved, the voucher is recorded in the accounts and filed by the due date. Upon payment, the voucher is recorded in the same manner as the payments of an accounts payable. In a computerized system, it's simpler because we have everything happening at the same time, and controls is much stronger in a computerized system. So data from supporting documents such as purchase orders, receiving reports, and suppliers' invoices are entered directly into the computer files. At the due date, the checks are automatically generated and mailed to creditors. And sometimes we can also rely on ETFs. So at that time, the voucher is electronically transferred to a paid voucher file. So cash paid by EFTs, again, it's the other side of the coin, which is when you are paying the payments using EFTs or electronic fund transfers. So cash can also be paid by electronic funds transfer systems. Example would be a withdrawal of cash from a bank account using an ATM machine, a payment of wages or salaries by an employer directly to an employee's checking account. And this is very common nowadays. Like most employees, they receive their salaries or their wages directly to their bank account using EFTs. And finally, a payment to a supplier or other vendor from a company. So let me stop here, and in the next video we're going to be talking about bank accounts, and we're going to be also talking about bank reconciliation statements.